All right, let's look at some of our talking points. We have, I look at our calendar. We have NVIDIA coming out with earnings next week. We're super overbought right now. Today's the 17th. We're overbought. That's why I think in the next week, we're probably going to be going down. It's very cautionary time. It's not time for the stocks to go up. But whatever happens with the NVIDIA report, that'll make the stock market go down or up in a major way. We have a holiday coming up on May 27th. Usually stock markets go up around holidays because people are out having fun on their day off. And there's a lot of good feelings. And there's less volume. There's people on vacation. So we expect there to be like a, let's look at so we expect there to be maybe the stock market go down next week right here. And when the holiday comes, we're going to have a little bounce. So that's a good little planning thing. We're done with earnings basically after NVIDIA. So there's nothing as far as catalysts in the stock market to make it go up or down after the end of May. That's why June is pretty much a not so good month. If we look at our monthly stock returns for the past, 40 years, we see that June is traditionally not that great of a month. There's no real earnings coming out. People are on vacation. There's not a lot of interest in the stock market. So that's why we have in our calendar pretty much flat to nothing really happening that month. July, we have the 4th of July holiday, and that always makes the stock market go up. So we always put green around that time. August and September are always or bad month. I don't know why, but we're just they've traditionally been bad months. Then towards the end of the year, we always seem to have some kind of a stock market rally. So we always look forward to that. Let's look at some things that have happened last week. We I guess the most important thing is we had some good inflation data that came out this week. So that made the yields to the 10-year Treasury go down. As the yields to the 10-year Treasury goes down, the stock market has gone up in a 1-to-1 inverse correlation. So that was the big news for this week. In stock market, it's pretty much it's overbought right now. A lot of stocks are they have momentum. Last week we had 75% of the stocks in the S&P above the 200. Now it's 79. So we still have these stocks last year that did bad are doing good this year. So that's still in place. And so far the Fed is kind of accommodative. It's not necessarily raising interest rates anymore. Okay, so we see we're right in the middle of one of the best months of the year, traditionally, and seasonality-wise. So that's why we are expecting good things this month in general. Okay, and we're super overbought now. We've been super overbought for most the last couple of weeks. Let me see. So it's not the time to buy. The time to buy is whenever you're at the bottom of the channel, whenever you have these stochastics really low, and you're at the bottom of the channel, like right there, and like right here. Yeah, right there and there. We're just right in the middle of that right now in our channel, and we're super overbought. So it's not the time to get excited to buy things. And if you're halfway between buying and selling something, it's time to sell it because this is the prime time to sell. Because we're approaching some of the worst months of the year in June, August, September. Okay. So here's a note from Bespoke. They're a pretty good company. They basically said where S&P closed yesterday at its most overbought level since April. Okay, so we're in almost all facets overbought. And overbought meaning it's not a bad thing. It means that people are excited about the stock market and people are buying. So a lot of times that carries with it some momentum and excitement, and people buy, and there's a fear of missing out. But that's basically a contrary indicator usually. That means that it's not the time to be buying when everyone else is buying. You can see what almost every one of the sectors that we're following, we're at extreme overbought or overbought levels. So that's usually an indication it's not the time to buy, even though everything else is going up. This is the time to keep track of stories that you like, because there's going to be a time when everything goes down 5, 10, or 20% or more. So you have to keep track of the stories that you're interested in and revisit them whenever people are pessimistic. All right, so we already talked about the inverse correlation, and that's continuing to happen. That's our nice indicator of where the stock market's going next. And you can also use that to predict whenever stocks are going up and down, because most stocks follow the S&P, and they follow the U.S. Treasury too a lot. All right, so nothing's really changed in any of the variables that we are following. Oil hasn't changed. Gold is up 5% this week. Dollar index isn't changing, and inflation isn't changing. So we always look to these variables to help us understand where the stock market's going next, but nothing is really changing there. Okay, just a reminder that commodities and gold are dollar denominated right now, and a stronger dollar tends to drive gold prices lower. And if it's a weaker dollar, then gold prices goes up. They go up. All right, so let's look at the fear and greed index. Right now, people are greedy. Last week it was fearful. A month ago we were fearful. Last week we were neutral. So right now, when people are greedy, that's the opposite. You have to do the opposite as an investor. You have to not buy, and you have to hold, or if you're inclined, sell some things that you're interested in selling. All right, and the AAII survey is where they're bullish, so it's like contrary indicator. If people are bullish, take some profits off the table or don't buy. Okay. Right now, VIX is at the lowest that's been in a year or more. So that means the stock market is not fearful. So you have to be very careful on this time, that when there's complacency in the market, that's not the time to be buying stocks. That's okay. All of our contrary indicators are indicating it's not time to buy. We have our emotional chart. Everyone's excited. New paradigm. We have people buying stocks that are meme stocks, and it's crazy valuations, and it's like at the top of our paradigm right now. It's not the time to buy. The time to buy is whenever people are despair. There's capitulation when things are going down 5 points, or they call it integers, when they're going down several points or several 10% at a time. We haven't seen that since the pandemic, but we're waiting for one of these news stories to actually instigate that. And so far, all these things that could have caused a crash are well in control. If any of these happen, you can just say goodbye to our new paradigm. Everyone's delusional, and people will start to be fearful again. But right now, we don't have that fear in the market, and we just have an overvaluation. We have the S&P is trading at a 23 PE, according to Wall Street Journal. That is like 35% higher than the average. So that means that any point in time we could correct like 30% and things will be back to normal, and you have to be willing to accept that as the long-term investor. All right, so the other things, we've been keeping track of the worst first. At the beginning this year, we were saying, the worst performers last year might be some of the best performers this year. And, it started out, utilities were starting out to be the worst again this year, but they're turning around to be the best. So you can see that they have tailwinds of possible AI. AI data centers are using a lot of electricity, and electricity and power generation is a big part of utilities. So they're starting to see a lot of inflows in the utilities. Also, because interest rates are staying higher for longer and not going down, the demand for high yield is higher. Um, let's look at, I said that wrong. Because the interest rates are higher, you would think that utilities would not be doing as well, and dividend paying consumer staples. However, high yielding investments right now are doing good, even though the interest rates are staying higher. AI revolution is still juicing stocks. We still have a lot of the stocks in our top 10 every day are AI related and weight loss related. So these are themes that are continuing to do well this year. The sectors that are doing the worst are real estate. That's primarily because interest rates are continuing to stay high, and a lot of mortgages are unaffordable, and that's making real estate less attractive. Let me see. Okay, but we have our best last year are actually the best this year also. So information technology and communication services were the best last year. You can see that they are the actual best performing this year. You can attribute that to earnings because these sectors, IT and communication services, they overlap in a way because they're related. They're basically the best earnings related stocks also. Okay, so that was a good little exercise there. Let's look at this is sector performance. At Fidelity, they keep track of all the sectors on one website. So you can visit here anytime you want in this link. Okay, so you can see right now that IT is the best sector. Communication services is doing good. Utilities, the ones doing the worst, real estate, consumer discretionary, and materials. And I guess the materials could be attributed to the US dollar that we just talked about. And healthcare, I thought would be doing good this year, but it isn't. It's actually one of the worst performing sectors. Okay, so let's look at what's going on in the sectors. Let's see. Okay, it's the U.S. market mover. Okay, some of the stocks that are going up and down. You can see that we have Chubb LTD going up today. This is the time of the year when the hedge funds, mutual funds, companies that manage over $100 million report their top holdings. They're called 13F, as in Frank. So we saw that Warren Buffett actually chose Chubb as one of his stocks that he's accumulating. So there's a large amount of people that follow Warren Buffett, and anything that he buys, people buy that same stock. So that is why Chubb is up. And it was up yesterday too. You can see that what other things are happening. Okay, we have Freeport-McMoRan. They're like a gold and copper mining company. Valero, we have Valero, Marathon Petroleum. So we have a couple stocks that are oil related. Let's see what oil is doing today. So if oil's doing, I would expect oil to be up today. Commodities. Let's look at the commodities. Oil is definitely up like 1%. Gas is up 4%. Okay. So that's why the energy companies are doing good today. A lot of companies, okay, we have the ones doing the worst are Dollar General, Dollar Tree. We have, okay, Walmart came out with really good earnings this week and it went up like 10%. And because of that, we have a lot of the companies that they're taking business away from, like Dollar Tree and Dollar General, they're going down. So let's look at, all right, I think a lot of hard drive related companies are down today. We have Seagate, um, we have Western Digital. I'm not sure why that's happening. Let's look at the NASDAQ, see what's going up and down. This is a Chinese stock, PDD Holdings. You can see we have a lot of, we've been talking about the KWEB, KWEB. That is the ETF for a lot of Chinese companies. It's been on fire. Remember Dan Niles at the beginning of the year chose the KWEB as the most out of favor sector that he thought would go up, and it's starting to go up a lot recently. We can see that a lot of these companies have AI in common. Alphabet, we have AMD, they sell AI chips. We have Tesla, they have a certain amount of AI. So let me see, the ones that are doing the worst. We also have some AI companies in there, Broadcom. We have Lam Research, and okay, so that's what we know for that. And okay, let's look at the sector, the ones doing the best and the worst today. Okay, we see ones doing the best and worst. We technology not doing so well, and the ones doing the best, there's energy. Energy is up because of the price of oil and the price of gas is up today. We have communication services, financials. I guess this is, let's see, utilities. Okay, these are all sectors that did the worst last year, and they're doing the best today. And we're kind of doing the ones that did the best last year are doing the worst this year, and that's the worst today. That's what we can see from that, but it has a lot to do with the 10-year Treasury going up today. Okay, that was a good little excursion. Let's look at some more things in our talking points. We're going to look at Dan Niles' picks. Before we were worried about KWEB and what was he thinking, but his reason for choosing KWEB, this is the Chinese ETF, the largest companies in the Chinese sector, and it has gone up like 20% in the last couple of weeks. So it is starting to outperform. And Texas Instrument went up 10% in the last week or two. So these are actually becoming super high performing. The one that hasn't come to fruition yet is XBI, and that's the biotech ETF. So we're keeping our eye on this. I mean, this guy is really smart. Sometimes his picks don't realize really quickly, but we can see that he is really good at being a contrarian. He likes to find value in places other people don't. And so far as Amazon and Meta picks are doing really good. And I think I like to think that I'm a contrarian, and I like to think contrary ways. Like right now he's been right this year. So let's look at KWEB. It's went up in more than in the past week. It's overbought, and so far it's gone up like 30%, not 20% in the last couple of weeks. And I guess this is the time to start looking at it whenever Dan Niles was interested in it because it was totally oversold here and at the bottom of its channel. And we'll just mark that as a lesson learned. It's way out of whack right now. Let's look at some more talking points. There's a interesting phenomenon that happened this week in the stock market. We had this guy named Warren Kitty. He posted the picture of a guy coming up in his seat, and then all the meme stocks just took off. So we can see from this, you can see GameStop went up 179%. Then it went down another 60%. The thing to keep in mind whenever you see something like this happen, you just have to ignore it. You have to like any stocks that you were watching and you were thinking about buying, if it starts going up, you just have to say to yourself, I missed it. There'll be a time to buy it again. But this is a situation where these stocks are so bad, they're so poor choice for a stock that you would never want to buy it. And I'll show you the numbers a little bit later. But these are all stocks that were heavily shorted, and they were shorted because their potential of their company is really, really poor. Warren Buffett said, if you aren't willing to own a stock for 10 years, do not even think about owning it for 10 minutes. And I always think about that, whenever something like this happens. It's just, you just have to not touch it and ignore it because a lot of times, these crazy price swings in companies, they all go back down to zero again. So you're playing a game of, will this company go out of business before I sell my share or shares? This okay, this is the approach you have to take with mania stocks like tulip mania or anything that's mania related. Let's look at GameStop. Just that they've gone down another 21% today on top of this 21% that it went down yesterday. You can see that it has heavy losses in its projected earnings estimate. It doesn't go out very far, and that's only 1 year. But you can see it's still losing money in this negative earnings projections. So in general, it's you're playing a game when you invest in stocks like this that it might go out of business before you sell your shares. I mean, it could go up and down a lot. It's very volatile, but it's something you don't want to touch, especially whenever you look at the earnings estimates and the past earnings, and there's a lot of red. Let's look at AMC Entertainment. Okay, so the business model for GameStop, they sell used games, and people are playing games online now. You have digital downloads. You can't resell digital downloads. So the end market, I mean the things that they're selling have no future. It's like investing in Blockbuster when you know that everything is going to be streamed from Disney and Netflix. That's why a lot of companies shorted this company because the business model is horrible, and there's no real reason. There's no good estimates. So you have to because let's look at AMC. AMC Entertainment. They were hurt really bad by the pandemic because people couldn't go to the movies, and so they had to borrow money to get to survive that pandemic time. So they're heavily indebted. And what happens whenever you have this mania like this, it's almost like throwing the company a lifeline. They can sell stock at the market so that they can borrow more money to lose money some more. So what happened was, as these stocks rallied in the last week, they started issuing more stock that dilutes the value of the existing stock. And it's just like, it makes the stock worth half of what it was before. And you have more debt. It's just like a nightmare. And you just try to ignore this. I mean, I'm just looking at this. If you see this in your earnings estimates, like negative earnings, you just have to run and don't even look at it and ignore it. That's all. That's just like a lesson learned. You're just playing a game. Will the company go out of business before they make a profit? And I don't want to be stuck in that musical chair game. All right, so this is one of the my favorite times of the year. Every quarter, we have something called 13F reporting, and that is whenever the big mutual funds, hedge funds, billionaires, and companies that have investments, they report their current holdings, changes in what they buy and sell. And a lot of times you get some good ideas for new investments from that. And there was one mystery stock that Warren Buffett and Berkshire Hathaway was accumulating, and that is in our top 10 today. And when we looked at the top performers, Chubb, it's an insurance company, something Warren Buffett knows a lot about. So I thought it'd be interesting to go over the financials of Chubb and if it's worth investing in. So Chubb right now has I mean, the investing world right now has some tailwinds. Right now, the insurance companies have a tailwind of charging an exorbitant amount for insurance. And that's one of the things that isn't changing. Insurance rates are going up a lot. If you've seen your insurance policy for your auto insurance, it's up a lot. And so insurance companies are actually charging more and getting away with it. And so that is something they have. I looked at their growth. It is a consistent 9% growth for the next couple of years. So that is really good. It's very consistent. Their PE is 11. This is probably why Warren Buffett liked the company. Warren Buffett likes to buy companies with low PE ratios. And so right now they're growing at 9% with a PE of 11, which is really low. And so their PEG ratio is 1.22. So they're very close to fair value, maybe 20% overvalued. And they have a 1% dividend. So that makes it a 10.36 total return. So if they have a consistent 9% return, estimated return, that's a good buy and hold 10% return company. But let's look at some of the financials just for kicks, just the statistics. It's a small company, 102 billion. Warren Buffett probably could buy this company if he wanted to buy it because he has that much cash. Its forward PE is its forward PE is 11.6. And Yahoo Finance thinks that they're only growing at 3%. So they have a PEG ratio of 3. That's 3 times overvalued. The profit margin is really good. That matches what we look for. I think what we look for in stocks is very similar to Warren Buffett. They like profitability to be above 10 and return on equity to be over 10. So that matches our criteria for stocks. They have more debt than they do cash, but insurance companies are a lot different and banks and insurance companies, they have different debt levels that we don't understand. We like to keep the debt level reasonable. And the amount of debt they have is about, if you X out the cash, that's about 13 billion out of 100 billion. So that's not that bad. And they pay a dividend of 1%. So that's interesting that he bought this company, Warren Buffett. What I like to do, the price of this stock has gone up 10% in the last week. since they announced this. What I like to do is I like to keep track of that level of like 220 is when Warren Buffett was buying it. What you have to do is like mentally keep track of that number. When a stock market sells off, maybe Chubb will be back down to 150 someday. And you know Warren Buffett bought it at 220. So you can start accumulating the stock like at 150 whenever the hype is gone and people are worried about a war or something. All right, so this is an example. This is very similar to GameStop and AMC from this week. You know, the stock has gone up 10% since they announced this. You have to let it settle down like maybe 3 days before you think about buying it. For me, I like to wait until like a stock market crash, and I know this could be like a long-term stock to buy. You can see the great thing about this company. Look at the earnings. The earnings are like in a straight line up, and they're going to go up 9% a year for the next foreseeable future. So that's an example of quality stock. All right, so let's look at next thing. Hold on for a second. Okay, we're going to look at some changes in Pershing Square's holdings. Pershing Square is Bill Ackman's hedge fund, and we went over it last week. And basically, they came out with a 13F saying what has changed in his portfolio. So let's go over that again. He's basically, you can see he made a big bet on Chipotle whenever it was out of favor. And he bought it. You can see he made 600% on it. So what he's doing right now is he's over time liquidating. It's 18% of the portfolio, and it's overvalued right now. So what he's doing is he's liquidating some of that and putting it into this QSR company. Over time, he's going to be selling more of this Chipotle and putting it into things that are more undervalued. Like he bought Alphabet. You can see he has an 18% total Alphabet position right now. If you add up these two, and that's his biggest position now. And Hilton is one of his biggest positions too. So, so that's interesting that he made that change, and over time he's going to be reducing his position in that because he's already a lot of times whenever you make a lot in one stock, you don't want to, you have to start taking some off the table and diversifying. Otherwise, you have a little more danger in your portfolio. Okay, let's look at Warren Buffett did with his holdings. He reduced his position in Apple by 12%. Okay, that's another example of a position management. It could be a position. Warren Buffett said he did it because the if he sold some in the future, there'd be higher taxes. So it's better to take sell it now, but still it's a position. He has 39% of the stock of his position in Apple. So he took it down from 50 to 40%. So he's probably going to sell more. This is the second time he sold it consistently. So he's going to be just like Chipotle is being sold by Ackman. He's going to be selling, Warren Buffett's going to be selling more of his Apple every quarter to get this Apple position maybe down to 10 or 20%, maybe. But he sold some of his Chevron. He bought more Oxy, which is an oil stock, and he made a brand new position in Chubb. So that was an interesting look at his portfolio. We looked at Guy Spire last week from Aquamarine Capital Management. He didn't make any changes at all, really. He sold just a little bit of Ferrari, and that was his only change. He left every other position the same. Let's look at Mario Gabelli. He's actually Um, it's a much different portfolio than everyone else's. He has around less than 2% in most of his positions. So, and he does a lot of selling, more selling than the other managers do. Um, so it's kind of hard to track, really what, um, well, he has smaller positions and it's not as interesting as the other um, hedge fund managers. Daniel Loeb, third point. He made some changes. He reduced Microsoft by 12%. He added Amazon by 21%. Meta, he added 6%. He got rid of um, a steel company, U.S. Steel, and DuPont. Totally got rid of U.S. Steel and DuPont. International Flavor, and he added um, Intercontinental Exchange. So that's interesting. He made big changes to these large mega cap stocks, and this is the only company that I saw that was actually selling Microsoft. All right, so this Meta and Amazon, that kind of matches what we saw from Dan Niles. At the beginning of the year, he predicted Amazon and Meta being the best performing stocks this year. And you can see, like my great minds think alike, I think. So let's look at Fidelity Contrafund. They have to report the changes in their portfolio too. So you can see that their changes are very small. They're not very large changes, but they added to NVIDIA. They reduced their position in Apple, like Warren Buffett did. And United Health, you can see that a lot of hedge fund managers are reducing their United Health positions. Eli Lilly reduction, and you see they added to Visa position and General Electric, and they reduced Exxon and Accenture. All right, so but the amount that they reduced isn't that much and added to. JP Morgan is the one they added to a lot. They made a big position in that. They added 18%. So that's a good, whenever a company like Fidelity adds 18% increase in a position, there's a very good chance that that stock is a decent stock because they tend to hold their stocks for a long time. All right. Let's look at Magellan's changes. They added to Alphabet, and this is the biggest change that is notable. They had a 129% addition to Intuit. So Intuit is the company that does TurboTax and the business software side of things, and they make software for small businesses. So the great thing about Intuit is that they're actually cracking down on people sharing the tax programs. So this year they actually made it harder for people to share tax programs between people. So that made more people buy their product. And that could be the tailwind for that company. Um, let's look at Intuit just to see what their numbers are because we haven't looked at it for at least a year. Look at that. And this is E-Trade. This has the best charts for earnings projections that I can find. Okay, so it gives you E-Trade gives you two pieces of information that are important. It gives you the overall view of the company. It might take a while here. Okay, you can see that their PE ratio is 66. That is pretty high. A lot of times when companies have a PE of 66, they have some kind of moat that um, it's hard to compete against. So they do have a good portion of the tax software market and the home business market for software. Taking a while to get there. Okay, let's look at the earnings projections. Okay, so we're dividing these by years to see what their earnings are here. So it's 16.41 divided by 18.85. So that's 13% growth. That's not that great. 18.85 divided by 21.59. It's 13% growth. 21.59 divided by 25.7. Okay, so it's around 13 or 14% growth next couple of years. And you can see when you look at this chart, the quarter three is always like the best quarter. You can see it's growing. You know, you have to understand that's the time they receive their tax software money. So that's always going to be their best quarter. And you can see it's going up in a straight line, but it's only going up 10%, 10 to 13%. So for a stock that's trading at a PE of 66, that is a premium. This stock could easily drop in half on a bad news story. But it might be just consistent growth though that makes it keep that 66 PE. I don't know. I wouldn't be interested in this. I would rather wait for it to trade down to a peg ratio of much lower. Right now, its peg ratio is like 6, which is pretty outrageous. Because if it's PE of 66, let's look at that. If it's 66 PE divided by, they're growing at 14%, 4.7 peg ratio. That's way too much, too expensive for me. Okay, so let's look at the Growth Fund of America changes. They reduced their stake in Meta and Amazon, added to Eli Lilly, General Electric, and MasterCard. They reduced Alphabet, another reduction of United Health and Tesla, and they added to Vertex. Okay, so we see some similar changes across several different funds, and these are all kind of hints that if you want to reduce some positions in United Health, that this is probably a good time to do it because we see a lot of fund managers, losing their faith in that company. Let's look at BlackRock Technology Opportunities Fund. I chose this because it's the largest fund that's not Fidelity or any of the big ones. They're reducing Apple by a lot, 9%. It's very similar to how Warren Buffett reduced his Apple. Reduction of Meta, MasterCard, Visa, and Alphabet. We see a similar reductions. And they added to CrowdStrike, ServiceNow, Micron, Salesforce. Okay. Okay. This week we saw Walmart come out with good earnings, and their stock popped like 10%. And so you can see they're overbought right now, but they have some momentum and they're going up. This is one of the strongest stocks in the stock market right now that we're following. And it has a 1% yield, so it's a very safe stock for this environment where we have high inflation. They can charge higher prices, and they're getting a lot of people that are wealthier to trade down and buy things there. And maybe Target, Dollar General, and Dollar Tree, they're going down today probably because Walmart's eating their lunch. All right, so you can see Walmart. Let's look at Walmart. they're growing around 9% if you average the next couple years. So they're growing 7, 9, 8, and 12%, which averages around 9. Their PE is 33. That's pretty rich. That's very expensive. But a lot of these big department store companies, they are selling at a high PE because they have consistent growth, it seems. They're 3 times overvalued. They pay like a 0.43% dividend, so they have a total return of 10%. So this is a stock that also is growing around 10% with the small dividends, very similar to the Chubb growth rate. So this is like a stock that Warren Buffett would be interested in if it sold off. Warren Buffett actually wishes he bought this. He mentioned in the past, and I'm sure it's on his radar to buy if it goes down a lot. But the valuation is a lot like Costco. Um, they have a similar business model as Costco, where they have Sam's Club. They have a membership fee to go in a Sam's Club, and they have a similar business model to Amazon, where they're actually doing e-commerce and they're actually delivering to people like Amazon. And they also have the Walmart, almost the Walmart Prime service. I don't know what it's called, but they have free delivery if you pay $100 a year or something. So they have a lot of business models that are similar to successful companies like Costco and Amazon, and that could make them grow. Um, and they're doing well in an environment where everyone's trying to save money now, and it's a logical. Um, I buy a lot of things at Walmart because it's a one-stop shop. You go there and you get everything done. You get your oil change and you get your groceries and everything that you can imagine in the house. Um, so okay, that's a little good excursion. The last thing I want to go through is this iShares Quality Factor ETF. It's QUAL is the symbol for the ETF, and its investment objective is to track the investment results of an index composed of U.S. large and mid-cap stocks with quality characteristics identified through certain fundamental characteristics. And they have similar characteristics that we're looking for and what Warren Buffett looks for in a stock. So that's why I like looking at this. And I thought it'd be interesting to return on equity. We know that's important. Return on assets, return on invested capital. So they have a lot of these similar features, and I like to look at their top 10 holdings as soon as it's updated. So let's look at, let me see, the top holdings for the Qual ETF. And a lot of these are similar to what we're already following. So it shouldn't be any news to you, because we're following these. NVIDIA, Visa, Meta, Microsoft, Broadcom, MasterCard, Apple, Eli Lilly. So these are all stocks that have that high return on equity. They're very profitable companies. If you don't like following and buying individual stocks like I do, you could dollar cost into a stock like an ETF like this and get similar results. Because this, I'm sure this money manager has um, similar criteria to follow. I like almost every one of these stocks, and I have a lot of them in my portfolios, and we've been following these. And it's a good whenever you go over these top 10 stocks of these money managers, you keep these in the back of your mind because eventually every stock on this list is going to sell off like 10, 20, 50%. And you got to know that these are quality stocks, and you got to be willing to put out your bucket when it's raining gold. And you have to buy some, if it sells off, if you're interested in this kind of stocks in your portfolio. But right now, a lot of these are just, they're running up a lot. The stock market's overpriced, and but that's why I keep track of each one of these. Eventually, we're going to have some news stories for for these stocks that they're adding, and they're going to go down. And then we're going to say, well, is this still a quality company? Is this still something you can buy and hold 10 years? And that's something to keep in mind. That was an excellent little talk we had today. I hope you have a really good weekend. That's going to be it for my talk today. And I hope you have a good investing outcome next week.